We think the last uncertainty before we move into what we believe will be a very strong recovery from a rolling recession, maybe starting with a rolling recovery, but gathering momentum. And we think by midterm elections next year, clearly on the up and up with big upside surprises in real growth, productivity, and downside surprises on inflation. So that would be another positive because of productivity. You can see that Bitcoin to gold is maintaining its uptrend. We'll see if it breaks out. I think the risk-on trade has helped it recently, and we think that will be the case when that case will continue when it is clear that we're not going into a long-term recession, that the Fed is going to ease, and that a strong productivity-driven boom, I would say, in economic growth is underway, paving the way for midterm elections that should favor the majority now.
Cathie Wood begins her analysis by zeroing in on the biggest swing factor in markets right now: interest rates. Despite growing signs of economic weakness like softening housing data and slowing consumer spending, Fed Chair Jerome Powell took a surprisingly hawkish stance this past week that's caught many off guard, especially those expecting imminent rate cuts. By the way, if you're enjoying this breakdown, make sure to like the video, subscribe, and drop a comment below. It not only helps the channel grow, but also signals to the algorithm to share this content with more people like you. Let's continue. Cathie argues this disconnect between policy and data is creating volatility, but also opportunity for disruptive innovation plays, including crypto and AI. Now let's just watch more clips from the interview.
And one of the big variables that many people are wondering about now is interest rates. This week, Chairman Powell sounded very hawkish. I think he didn't appreciate being featured along with President Trump at a construction site. So there may have been something else going on there, because the data as it is evolving here is certainly moving in a direction that would lead the Fed to ease. And of course, for the first time since 1993, there were two dissents on the Fed board this time around. And that suggests that we probably are going to see interest rate cuts in the future. I think the odds for a rate cut in September are up to 88%, and a 50 basis point rate cut, maybe they're up to 25% or so. We think that will resolve positively as well. That's the one uncertainty. And the reason this matters is if people think rates are going to come down, then they're going to wait and see how low they go before they take major actions or make big purchases. So getting back to some kind of equilibrium is going to be important. And that is, we think, the last uncertainty before we move into what we believe will be a very strong recovery from a rolling recession, maybe starting with a rolling recovery, but gathering momentum. And we think by midterm elections next year, clearly on the up and up with big upside surprises in real growth, productivity, and downside surprises on inflation. So that would be another positive because of productivity. The dollar, I know the headlines were blaring, worst dollar start to the year, our worst first half since, I think, 1993, if I'm not mistaken, which, by the way, was the last time two Fed directors had dissented from from the policy being made. So you can see that all of that drama put in context was a little exaggerated, shall we say. And if you look at the next chart, I did present it for the first time last month, you can see here that the uptrend has not been broken. And if we're right on return on invested capital, it will resume its increase relative to the 26 countries in this index. Inflation, as measured by commodities, it is kind of shocking still that tariffs notwithstanding, it's today where it was in the early 90s and in the early 80s. Here's the S&P price to gold. This we're paying a lot of attention to because some of the best strategists out there, our friends at GovCal, have been suggesting that we were going to spiral down into a 70s environment with tariffs causing inflation and so forth. The market's been weighing that risk, as you can see here. The most recent move, however, in this index has been up, and we think it will resume as we get through this uncertainty, especially the uncertainty around recession and the Fed. Here, relative to oil, we think this is a leading indicator of what will happen, and it looks nothing like it did in the 70s. Here, I always like to keep this chart in mind. I started my career really near the peak of interest rates, and have been riding down the curve throughout my career, which was delightful. But you can see there's a downtrend, which is good up to a point. What did near 0% Treasury yields mean? It meant, in the case of COVID, are we going into a deflationary bust? And we got out of that. And maybe we have just bounced back to something more normal now that the Fed is letting markets work. We do think that the Fed is actually erring a bit in the other direction, as I mentioned before, and that will change. And with it, we do think interest rates along the entire yield curve will come down. And here's Bitcoin to gold. You can see that Bitcoin to gold is maintaining its uptrend. We'll see if it breaks out. I think the risk-on trade has helped it recently, and we think that will be the case. When that case will continue when it is clear that we're not going into a long-term recession, that the Fed is going to ease, and that a strong productivity-driven boom, I would say, in economic growth is underway, paving the way for midterm elections that should favor the majority now. So with that, I know a lot of puts and takes, a lot of charts, but it was a busy day for sure in the markets, a lot of fear surfacing once again, and yet the way we're interpreting this is another indication that the market is climbing a wall of worry. And we need these shudders every once in a while to keep speculation in check. And we think that's just another one of those checks.
Cathie Wood highlights the key sectors she believes will drive the next phase of economic recovery: housing and capital expenditures. Housing has been in a deep freeze, locked up by sky-high mortgage rates that sidelined buyers and slowed construction, but cracks are beginning to form. Home prices in several markets are starting to cool, and early signs of improved affordability are emerging. If the Fed moves to cut rates this fall, Cathie expects housing activity to accelerate rapidly over the next 6 to 9 months, unlocking demand that's been building up on the sidelines.
As I mentioned, Chairman Powell sounded quite hawkish even though reporters were saying, well, wait a minute, housing seems to be relapsing. And he deflected that. And, well, wait a minute, the metrics you look at in terms of core growth and core inflation, they're all moving in the right direction when it comes to inflation, and actually in the wrong direction when it comes to GDP growth. I think I'm not going to get the metric exactly right, but what Chairman Powell focuses on is real private domestic final sales, and that is running in the 1% range. And we saw that with the consumption figures, very slow. The consumer is becoming quite cautious and beginning to lift the savings rate. We think that could cross 5% this year. But you see, money growth did start turning around. It was negative for quite a while. We're now up to roughly 5%. But when you get cautious consumers, that means the velocity of money, the rate at which it turns over, slows down. So the stimulative effect just isn't going to be there the way that this chart might suggest. We also know that the CPI, which is depicted in the green here, faces some tough comparisons. So I think we have two more tough comparisons at the 0 and 0.1% rate for the next couple of months. So the inflation rate could stabilize here, and maybe that's what Powell was responding to, just knowing that the optics aren't going to look great on inflation, meaning continued progress. But if we're right, that will be it. Then we're off to another leg down in inflation towards the 2% and actually below the 2% range if we are right. Now, of course, we have been expecting much lower inflation for quite some time. Tariffs are complicating the situation perhaps a bit right now. But there are metrics out there. Oh, well, before I go on to inflation, let me just depict Fed policy here. This is the 2-year Treasury yield less the 3-month Treasury yield. And when it is below zero, which it is here and has been for quite some time, monetary policy is restrictive. You can see every time this has happened before, we end up in a recession. And, we're very lucky we haven't ended up in a full-blown recession. It's been more of the rolling variety. But we do think, because of how long this has taken place, the Fed jacked rates up in 22, so it's been 3 years, that a lot of rubber bands are stretching, particularly in the housing and capital spending markets. The housing needs lower rates and or lower prices, and we are starting to see lower prices moving affordability up slightly. I think lower interest rates will really get it going in the next 6 months. And capital spending, now we have certainty with this tax package, and I think those two sectors are very high multiplier sectors. In other words, $1 spent on housing causes all other kinds of spending to take place. When you move into a new home, you're buying lots of stuff. And the same with capital spending, lots of follow on from $1 spent on capital expenditures. So we do think the Fed's too tight. This chart is reinforcing it. We're starting to see a little progress. We've seen a relapse, and we do think it might mean that in September we'll see a 50 basis point cut, and perhaps for the rest of the year, 75 basis points when all is said and done, especially now that employment is showing such weakness.
Cathie Wood reflects on a persistent and historically significant signal in the bond market, the inversion of the 2-year versus 3-month Treasury spread. This isn't just a random metric. It's one of the most reliable indicators of overly restrictive monetary policy. Historically, when this spread turns negative, a recession tends to follow within 12 to 18 months. What's surprising this time is that, despite the inversion beginning back in 2022, the US has avoided a sharp, broad-based recession. Thanks for watching. If you found this valuable, the next video is even better. Click it now and let's keep going.